Hello and welcome to the Global Dialogue. I'm Shereen Bhan, and joining me on the program today is the Global CEO of Standard Chartered, Bill Winters. Bill, thanks so much for joining us here on CNBC-TV18. It's great to have you join us on the program. You've missed the G20 quite literally by a whisker. A lot actually got done as part of the New Delhi Leaders' Declaration, including on finance. Of course, the need for more global cooperation on things like crypto regulation, multilateral development bank reforms, and so on and so forth. What's your big takeaway?
First of all, it's really nice to be here, basking in the glow of a really successful G20s. Certainly everything that we saw and everything that I've heard subsequently from government leaders, business leaders, etc., since I've been in India, is super reassuring. And you're right, I missed the event. I don't think a lowly banker was invited to the head of state meeting, but I had the great pleasure and privilege of participating in something that's called the B20, which is a group of business leaders. In the case of this B20 meeting, working as a co-chair of a group with a COTAC that was tasked with coming up with recommendations for the G20 on how to marshal global financial resources for the developing world broadly, with a focus on sustainability and transition financing, but not limited to that. And I was very happy to see that the recommendations that we made into the G20 were picked up, discussed, and some of which really made their way into the programs, like some of the things that you mentioned. So the reform of the multilateral development banks, it's prospective, right? Yeah. It's an idea, but we have a new head of the World Bank who's quite committed to stepping up the level of engagement, in particular in helping developing nations fight climate change, but also deal with the consequences of climate change. Right? As much as we think we can avoid temperatures going up more than 1.5 degrees, I question whether that's even possible anymore, given how far behind we are. Nevertheless, even in today's temperatures, as we're seeing yesterday in Libya, last week in Hong Kong, and the week before that in the south of the U.S., the consequences of rising temperatures are absolutely profound, and we have to spend money today to protect economies and communities. And these are actually kind of no-brainer investments, if I could call it that. The money that we spend today will save 10 times as much money down the road. So the fact that the G20 is tackling these issues in a relatively concrete way is very reassuring to me, and I'm happy that the business community is feeding into some of that.
You know, speaking of the partnership between the G20 and the B20, and you referenced the World Bank's new president, Ajay Banga, and I had a conversation with him 24 hours ago where he talked about the need for, of course, a bigger balance sheet as far as the World Bank is concerned. But he said, look, that's not going to be enough. If the bank's aperture needs to consider things like climate finance, etc., and not just poverty alleviation, you need the private sector's involvement to deal with some of these challenges and with some of these issues. You know, as part of the discussions, the deliberations and the recommendations that the B20 and the task force that you were part of with Uday Kotak made, where is the money going to come from?
Yeah, the money is there. There is enough money. The public sector has some money earmarked, but nowhere near enough. Of course, part of the MDB reform is how do we get more capital into the World Bank, into the African Development Bank, into the AIIB or the New Development Bank, or these newer MDBs. And that's a question of the shareholders, governments in other words, to increase the funding. But Ajay is absolutely correct. That won't be enough. What we really need to do is to have that public sector money crowd in or bring along with it many multiples of the public sector money in private sector money. So today, if the World Bank, on average, lends $1, that's crowding in less than $1, 95 cents, of private sector funding. That's crazy, right? $1 of World Bank funding should be crowding in $15 of private sector funding. In order to do that, the public sector funding is going to have a different risk profile than they've had historically. So when we talk about MDB reform, we're talking about increasing the amount of capital that they have, but also increasing their ability to bring the private sector along. Now, Standard Chartered Bank, that's what we do. So we're the largest issuer of World Bank guarantees in the world. And a lot of those projects are targeted at core infrastructure in developing economies, and increasingly into environmentally sustainable infrastructure projects. So we know how the system works, and if you have somebody who's prepared to take, often it's just taking the political risk, or taking the risk around the development of a project, which is the most difficult thing to finance in a big infrastructure project. It's the completion of the building, technical challenges. If we have people that can take components of that risk, then we can bring in all the pension funds, the insurance companies, the banks, other generic participants in the capital markets who have ESG mandates.
Yeah.
They want to invest in sustainable things, but they don't have the technical competence themselves to get into these really complex elements of the capital structure. So our mission as a bank is to work with borrowers, work with the multilateral development banks, work with export credit agencies, work with capital markets investors, ESG and non-ESG, bring the package together so that we can get that real crowding in. And we're talking a need for $100 to $150 trillion.
Yeah.
Right? This is like serious money.
Yeah.
We can only do that if we harness all the resources of the private sector, catalyzed by the public sector. But we can get this done. There's a way through this.
How close are we to being able to get this done? Are we today at an inflection point just because of the challenge, the enormity of the task at hand, as well as perhaps the political will, as well as the political capital and the private sector's capital willing to work together?
As I said, I think there's enough money. I don't think that all of the financing frameworks are firmly in place. So Ajay Banga at the World Bank, as you mentioned, he's asked Mark Carney and Sri Vadera to co-chair what I think we're calling it a World Bank lab.
Yes.
I'm one of the private sector participants in that. There's a few of us who are coming together to say, what are the pilots that we can run? What are the structures that we can put in place? Where do we require a new mandate or a new vehicle that doesn't exist today? And where is it just a matter of working through, what works in the real world, in the market? How can we replicate that 100 times over? So that sort of thing is happening under the leadership of the World Bank, and it's fantastic to see. But in some cases, we know it's going to come down to freeing up money that otherwise would be used for something else. And in this environment, with cost of living crisis in many markets, inflation is running high. The global economy is in pretty good shape, as a matter of fact, and you may want to talk about that later. But nevertheless, there are economic pressures everywhere. Even in India, where growth is booming, you feel the economic pressure. There's competition for resources. And I think as a planet, we've got to decide, do we want to make an investment in our existential future, or do we want to consume more donuts tomorrow? And not to be too simple about it, but the donuts tomorrow, it will kill us in the long run. We have to make some trades along the way.
Well, I think you've simplified that, but that's essentially the choice that people need to make. But, let's talk about the real world, and let's talk about the global outlook at this point in time. For the bank, you've had a very strong first half. Income up 18%, profit up 28% year on year. If you look at the global economy, the US, Janet Yellen talking about a more certain soft landing. India here, growth is looking strong. China, we don't know whether we've seen the worst of the unraveling or more to come. Size up for me the global economy, the global mood today.
Yeah, I'm pretty optimistic overall, which is not to say there aren't real tensions. So inflation is still running high. Wage cost inflation is also running hot for some really good reasons. I don't think we fully absorbed the COVID impact and the post-COVID impact. The supply chain disruptions that really afflicted the market and contributed to this big inflation problem, I'd say have largely resolved, but there's still a tail of working through that's putting some pressure. The relative weak spot compared to, I think, what some of the expectations were earlier in the year has been China, where economic growth has been a little bit sluggish. I think that's been driven by a few things. One is the ongoing supply chain challenges. I think China is just it came out of COVID late, so it's taking a little bit longer to process that. Second is this overhang in the real estate market. So there's been what would have been, if it happened in the West, it would have been a real estate crisis. We'd have a collapse in real estate, and we've seen it. In my 40 years in banking, I think I probably lived through 5 real estate crises of a major variety, the most substantial of which obviously was the great financial crisis. And real estate crises are bad in and of themselves, but when they then infect the financial system, then they're really bad, like maybe 20 times worse, as we saw in 2008, 9, 10. And I think the Chinese are quite determined to decompress their property market without destabilizing the financial sector. So far, so good.
But do you believe that they will be able to manage this decoupling that you speak of?
I think they're doing a good job so far, but it's very painful. So we've taken losses on commercial real estate in China.
Will you need to provision more?
Well, who knows? We've provisioned, we think we're properly provided right now. We don't have very large exposure, but we have enough so that we felt it. It was really the only loan loss provisions that we've taken over the last 18 months, but for a couple of the sovereigns that have restructured in Sri Lanka and Africa. But the biggest losses that we've taken are in Chinese commercial real estate. But the market seems to have broadly stabilized. The stimulus packages are having an effect, but it's not lifting the market back up. So, but the financial system in China is still very strong, so that there's no concern that this is spilling over to the banking sector or the Chinese have also done a very good job of reining in the non-bank sector. So I'd say the jury's out on how long it will take for China to get back to its potential growth rate and where the growth will go from there. But they're managing things quite directly, and I would say so far so good.
Let's address the issue of what we saw happen as far as the banks were concerned. And then you said, I think it was in May, you said that you were a net receiver of deposits during this period of global angst.
Yeah.
What do you anticipate now in terms of what this could potentially mean for you, for market share, etc., as we move forward? And what are the lessons that have been learned through this crisis?
Well, I think it's this regional bank crisis, as I think it's come to be known. Although obviously the big victim was Credit Suisse, in that very different set of problems. Credit Suisse, they had serious problems with the business model for some time, but the U.S. regional banks was a surprise to the market. And we know fundamentally it was a crisis of confidence. There was a liquidity mismatch and some misallocation of resources, in particular in Silicon Valley Bank, and the consequences were clear. The U.S. acted very assertively to effectively backstop the deposit system in the United States. That will come with a tail. Yeah. The tail is moral hazard. But regulators are very, very aware of that and will work around it. Of course, everyone would prefer that had not happened. The Credit Suisse is obviously different, ultimately led to a crisis in confidence. The Swiss authorities managed to bring this together in terms of a merger with UBS. But it does raise the question, what will be the market reaction? The answer is, so far, not much, right? Because there's a sense that governments are aware that we cannot have another Lehman Brothers moment where there are questions about the financial system. But then that leaves the question, well, what are regulators going to do to make sure that we don't have another Silicon Valley Bank or First Republic or Credit Suisse? The jury's still out on that one. Will they increase the amount of cash that we have to hold in the bank? Not a problem for us because we're holding a lot of extra cash in the bank anyway. But will the requirements go up? Possibly. Will we be required to hold more capital? I don't think it's connected to the U.S. regional banking crisis, but we've seen that the U.S. Fed and the FDIC have indicated how they're going to treat the new global system of banking reforms, known as Basel 3.1, with a significant increase in the required capital for, in particular, large banks in the U.S. Some of the U.S. bank CEOs have objected to that quite strongly. Is that in response to the regional bank crisis in the U.S.? I don't think so, but maybe the fact that they're coming at about the same time suggests that it's in the back of regulators' minds. Will there be more of that in the UK, in Europe, in Asia? Perhaps, although we haven't seen any sign of that yet. Because for the most part, the European, American, Asian banks are very well capitalized, very liquid. We don't have the kind of mismatches that we saw with Silicon Valley Bank, and we don't have the kind of structural problems that we saw with Credit Suisse. In fact, we've cleaned ourselves up completely. We don't have major litigation outstanding. We have had virtually no credit losses for the past 5 years. We have growing and strong profitability. We've got a really good market share, and we're super liquid. So I feel pretty good.
I want to understand how good you feel about the business here in India, because if I were to take a look at your numbers, you reported your highest ever profit before tax in 165 years in India. That was for FY22 at 6,480 crores, slipping a tad to 6,370 in FY23. How strong do you feel about India, about the India business? And I want to ask you a more general question about foreign banks and their presence in India, because you're an outlier in comparison to what we've seen others do. And it's literally 4% of the loan book and about 5% of deposits at this point in time. Why do you believe that's the case? And what is the aspiration for Standard Chartered in India?
Yeah. First of all, we are delighted with our business in India. It's a very strong business. We have a very strong corporate business serving both large Indian corporations who, very importantly, are investing increasingly into India. That wasn't always the case. Some of the big Indian groups were as inclined to invest outside as inside. That's changed, and resources are coming back into this super fast-growing economy. We're very happy to support that. I think we have a big market share with those companies. The international companies are also stepping up their investment in India. Now, you can look at FDI statistics from month to month and see a very erratic story. But every indication we have is that international investors are very keen to tap into the Indian consumer market, to the Indian infrastructure development, to Indian technology by investing in the country. And that's a very important part of our business, is serving those foreign companies on the ground in India. And of course, we're a local bank. We've been here for 165 years. We understand the market well. We understand the ins and outs. We also have a retail business. The retail business has gone from strength to strength over the past 3 years. So there's some measures of things like Net Promoter Score, which is effectively it's a customer satisfaction survey done by an independent party. We've been number one, I think, every 6 months for the past 3 years in terms of customer satisfaction in our retail business. Why? Well, of course, it's a nice brand. People like to bank with us. But we've got good people, good products and services, and we've been investing in digitizing everything that we do without losing the human touch. That's our approach. We're generating good returns on the capital that we deploy in India. We're paying healthy taxes to the Indian government, which is also an important part of our contribution to society.
Is that a concern, though?
It is a concern, yeah. I mean, we're paying a lot of taxes, but that's because we make a lot of profit, and that's what it means to be a part of a community. But all in all, we're very happy with our Indian business. It wasn't always thus. There were times in our corporate history when it's been quite difficult in India. But I think the combination of economic reforms that have been introduced by a succession of governments, but obviously accelerating under the current government, the fact that India is just in the right place in terms of its embracing of technology at a time when that's a distinguishing characteristic. And India's been quite welcoming to long-term foreign players, if I can call us a foreign bank, but who have made a strong local commitment. So you mentioned that we're a bit of an outlier. I'm not sure exactly what you had in mind, but
yeah, because many have either shrunk the businesses or left altogether.
Yeah, some have left, and we've done the opposite. We've doubled down. But we have been here for a long time, and we've got a particularly strong franchise. So we're increasing our investment in India. We will continue to increase our investment.
What would that mean, if you can quantify that for us?
So the biggest investments have been in technology. So creating a digital interface with our clients that is best in class. That's stiff competition because the Indian banks, of course, are very strong in their digital offering. It's adding relationship managers or bankers in both our retail and our wholesale business, which we're doing consistently. And it's making more capital available to our clients, both international corporations who are investing in India or who have businesses in India, as well as local corporations. Importantly, we've had some interesting innovations in India as well. So we set up, for example, a small and medium-sized enterprise e-commerce platform. It's called Solve. Built in Bangalore. It's now got something like 700,000 SMEs who are actively using this platform, processing tens of billions of dollars of transactions. And the reason that we did that is that we saw that there was a real crunch point for SMEs in India, where they weren't banked, I'll say, adequately by the local banks. The non-bank finance institutions were a little bit in and out with that sector. It's a super fast-growing part of the economy, and they needed access to different sources of funding, as well as professional services, as well as each other and their own supply chain. So their distributors and the people who provide product to them. So we set up this e-commerce platform. It's been a huge success, so much so, in fact, that we've replicated it now in Vietnam, in Ghana, in Kenya, and we will launch in other markets as well. It's a homegrown, it's a Bangalore fintech is what it is, that Standard Chartered happens to own 100% of. Now, we've actually sold off bits and pieces to different investors who see the strategic value. But it captures to me a lot of the story of India, which is technical competence off the charts. I mean, we do most of our technical development globally is done out of our Indian technology centers. Entrepreneurial, right to the core. Feeding into the small business universe in India, absolutely critical for us, but I think also for the economic development of the country. Promoting international trade, so the international connections between these small businesses that couldn't possibly access their suppliers who may be sitting in Korea or China or the United States. We can provide that access, get them financing. Very exciting. This isn't defining our business in India, but it's an indication of the kind of things that we can do because we're local, understand what's going on, and because we have access to really global resources.
You know, you talked about this interesting experiment that you've done, creating this sort of fintech business here in India. Two questions. Is that going to be something that you consider doing in other markets as well? Yeah. You know, or are you looking at collaborating with fintechs, because that seems to be the way forward for many banks, including Indian banks here?
Yeah, and all of the above. So we have a unit of the bank called SC Ventures. So this solved business that I mentioned, the SME platform, was incubated in our SC Venture lab. We have built in that lab 15 businesses, including digital banks in Hong Kong, Singapore, including banking as a service models that we've launched in Indonesia. So this sort of incubation is something that we do regularly. Solve, which I mentioned, is one of the more successful ones. But we've had great success overall. We partner in the bank with well over 300 fintechs. In fact, I had my management team in Bangalore. It was just before the pandemic.
Yeah.
And we had a sort of a fintech fair, and we had 20 of our most interesting fintech providers. So these are really partners of ours. And they came in and just showed us their stuff. And it was everything from innovative approaches to a mobile banking application or service to some nuts and bolts part of the payment system or something like that, or UPI interface, and really very specific things. Oftentimes we'll make an investment in those companies. We'll own 5 or 10%. And we do that because it cements a partnership, and because we think, if we take you to be our service provider, we're going to make your company very valuable, and we want to benefit from that a little bit as well. So we do have a big portfolio of fintech investments, but then we've got the innovation that's happening in our businesses, and that's ordinary course every day, and a lot of that technology is developed here in India.
You know, you talked about UPI, and I wanted to understand from you what you make of the UPI success story, and now that the UPI is moving out of India to other markets as well, and also, this sort of push for digital public infrastructure, which is sort of, which is what UPI is sitting on, and that's part of the G20 declaration as well. The significance and importance of that.
India has been an absolute leader in terms of introducing the cutting-edge digital economy into the day-to-day lives of every one of its citizens, or at least many of its citizens. It's an extraordinary success. Now, UPI is an interface for small value, frictionless payments, of course, has been replicated in many markets, whether it's faster payment services. Interestingly, one of the last markets to come on board is the United States, but even the United States is getting there. And but India paved the way in terms of making this available to the masses. It's a great equalizer. It's wonderful for financial inclusion. It's bringing people who have never experienced the formal financial system into the system, and this is a good thing. But of course, you can continue to build on that. I think there's a whole fintech ecosystem built around the fact that you can have a validated, secure, and a very efficient form of payments, a set of payment rails. And it's absolutely liberating for the economy. We're fully plugged into that and are innovating ourselves around these platforms.
I want to ask you now about interest rates, because the jury's still out on whether we've seen the worst as far as interest rates are concerned, or we are going to have to continue to live with higher for longer. What's your take on the implications of higher for longer for the global economy?
Yeah. The first thing to note is that the effect of higher interest rates is being felt.
Yeah.
And whether it's in the prices of commercial real estate, which obviously are also being affected by working trends, but clearly it's affecting asset values, and it's slowing economic activity. Right? I mean, the comment you made earlier about Janet Yellen suggesting that we have a much higher likelihood of a soft landing, I think she's right. But we're talking about a landing. We're not talking about maintaining 2.5% growth. We're talking about can we avoid zero or negative. So yeah, the economy is slowing, and inflation is sticky. So I think the big spike that we saw in food prices and energy prices on the back of wars and supply chain disruptions, that's coming back off. But the structural inflation around wage growth and wage expectations, inflation expectations, I'm afraid that's still entrenched. And so I think we're going to be higher for longer. And then we'll get slowing economic activity that will create a little bit of slack in the labor market. Wages will moderate, and then rates will be able to come back down. But I think we're stuck with higher rates for a while. From the perspective of a bank, that's not an entirely bad thing. I can tell you 0% interest rates is a very bad thing. 5% is fine. But we're also seeing the strains in a number of emerging market sovereigns, countries, where they've got an overweight in non-local currency debt, and now they're paying 5%, 7, 8, 9% when they were paying 0 before. And we've seen the restructuring in Zambia, in Sri Lanka, in Ghana. Other African or South Asian sovereigns are stressed. Yeah, but the trend is improving. So Nigeria obviously has a new president. They're appointing a new central bank governor. Obviously, oil prices at $90 is helpful for Nigeria as well. So I think these, Pakistan is also been on the critical list in terms of need for IMF assistance and the like. It's looking they may be able to get through without having to actually restructure their debt. These are encouraging things. So and then the countries that have been through the debt restructuring ringer, I'm thinking specifically about Zambia, Ghana, and Sri Lanka, are all on the road to recovery, which is encouraging. So high interest rates clearly putting stress on a number of countries and companies around the world. But the resilience of the system has been, some would say, surprisingly strong.
Well, speaking of resilience, and I'll end by asking you that, as you sort of chart out this independent future for yourself, what is the priority that you would like to address in light of the challenges that you see, but also the opportunities that you want to focus on?
Our strategy is really quite straightforward. We have a corporate bank and a retail bank. In the corporate bank, we're very focused on everything that leverages our cross-border network. So whether that's risk management and interest rates and currencies or commodities, or payments across borders, investments across borders, financing that taps into the broadest range of possible financial markets, even if it's an entirely local or domestic situation. That's what we do. It's high returning for us, and it's growing very fast. So we've been doing that for, well, I could say 160 years, but we've certainly been focused on that for the past 10, and that's going very well. On the retail side of our business, we've always been known as an affluent bank, and that's a very good thing, given our markets are Asia, the Middle East, and Africa, where affluence is growing at a wonderful pace. No more so than right here in India. So we've got we're the third largest wealth manager in Asia. So we've got an excellent starting point. We've got an excellent set of products and services, investing heavily in technology. We just want to keep that going. The mass market, where our market share is lower, and we have a very small market share in the mass market in India or in China. Digitize everything, best-in-class digital service, delivered in a seamless way. It's going to be more efficient, more productive, and a better quality experience for our customers. That's our strategy. We've got a fourth leg, which is sustainability. We are firm believers in the sustainable agenda ourselves. So we've got all sorts of policies around helping our clients to make their own transitions. It's a business for us. It's also a necessity, because our markets, I'm afraid, will be most impacted by an increase in global temperatures.
Oh,
so that's the strategy. So far, so good. It's working. We just have to see it through.
Yes. Well, we look forward to seeing you back here in India. And thanks so much, Bill, for joining us here on the Global Dialogues today.
My great pleasure. Thank you.
Well, with that, it is time for us to wrap up this edition of the Global Dialogue. From all of us here on the team, for now, goodbye. Thanks for watching. We'll see you again next week. Goodbye.